Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. And today our guest is Jeremy Roll. Thanks for being on the show again, Jeremy.
Oh, no problem, Whitney. Thanks again for having me. Really appreciate it.
Now, quickly, I wanted to remind the listeners to go to Life Bridge Capital and go to the Contact Us page. I'd love to connect with you personally and help you any way I can. You can schedule a call there, or we'll reach out to you. Also, go to the Facebook page, the Real Estate Syndication Show, where we can all ask questions, and you can leave questions that you want me to ask of experts like Jeremy on the show directly and get those answered for you so we can keep growing your business and learning and performing at a higher level every day. So, back to Jeremy. Jeremy, thank you again. And briefly about him, you should have just heard him yesterday. And if you didn't, I would encourage you to go back and listen to yesterday's show because this is going to be a continuation. And Jeremy went into detail about communication between a deal sponsor and passive investors, what he likes to see, the reporting, so a few things he likes to see in the underwriting and, just watching how sponsors communicate, what that tells him about them and numerous things. So I encourage you to go back and listen to yesterday's show. And then, today we're going to keep continuing that. And there's numerous things that I want to know personally. And that I know you're asking as well in your business as you're operating your properties and wondering, just how to communicate the best with investors and operate at a top level. And so Jeremy is currently an investor in more than 70 opportunities across more than $1 billion worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages a group of over 1,000 investors who seek passive managed cash flowing investments in real estate and business. He's also the co-founder of For Investors by Investors, also known as FIBI, a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate investors in a strict no sales pitch environment. So Jeremy, thank you again. Appreciate you doing, continuing this and doing another show. And so, but I'd love to jump right in, and I hope the listeners have listened to yesterday as well. But right off the bat, I'd love to know your thoughts about, investor portals versus, no portal. Or I'm sure you've been in deals probably that have both, or I'd love to hear your experience, about both and why you like one over the other, or if it matters to you.
Yeah, no, great question. And thanks again for having me on. I really appreciate it. Portals have become, so I've been investing for 17 years in syndications or passive investments. And I'd say portals have become more popular probably in the last 1 to 2 years. And actually, for those of you out there who are not familiar, you may notice if you've invested in multiple deals that have portals that the portal looks the same over and over and over. And that's because a company called CrowdStreet, which a lot of you out there probably know is a popular syndication platform, actually has white labeled their own interface and sold it off as a service to a lot of the syndicators. So that's by far the most popular one I see. It's honestly 90+% of the portals that I log into are CrowdStreet white labeled portals. So it's kind of nice because you already know where everything is. It's a very similar layout across all the syndicators. And also I could tell you firsthand, because I've seen some of the back office stuff they do, that they are really looking to improve it, and they seem to manage it very well. I know a lot of syndicators are very happy with that portal, and I have no affiliation with CrowdStreet at all. In fact, I'm an advisor for Realty Mogul, so if anything, I should be saying it's bad, but honestly, it really, really is actually good. I personally happen to like it, and I can tell you right now, the syndicators love it because it makes it much more efficient for them, and I just find it's nice to have everything in one place. Obviously, you can download individual documents. You can download multiple documents. I'll give you an example. This is a real life example, actually. Just yesterday, literally, randomly, I received a corrected K1, and we're recording this in September of 2019, and that was kind of a bummer. And I got that from an operator, and they had posted it into the portal that was CrowdStreet that they were using. And what I really liked about it is that I didn't have to go hunting for where the K1, even though I have it in a pretty well-organized folder. I have to go to my folder. I was able to download the previous K1, the corrected K1 from very quickly and open them up, compare them, and understand what changed, what was corrected. And so had I had to go, is a minor point, but let's say you're not well organized, you're not specifically purposely being well organized about this stuff, it's kind of self-organizing for the investor. So I tend to like it for that reason, and it's probably helpful for some of the investors out there. So that's my quick opinion. I would say that whether or not there's a portal, it doesn't change too much in that the reporting, requirements and what you would expect from a syndicator should stay the same. So it's just nice to have it in a unified place.
Do you like, being able to like log in on your phone and see it that way? Or are you mostly going to look at it on the computer? I've seen some portals that have a really nice app, and I've thought, that would probably be nice for some investors. Then I've seen others that, they still have a really robust platform, but maybe they don't have an app other than going through the browser. And I just wondered if that's something that you use.
Yeah, so I don't even know if they have one or not. I don't use it. But, this is true, unfortunate fact. I was using a very old BlackBerry until earlier this year. And just 2-3 months ago, I switched to Android, which is still a BlackBerry with a keyboard, but it's actually Android operating system. So even though I can use Android apps, I'm the wrong person to ask. So there you go.
No, fair enough. So anything else? So I think you mentioned that like if an operator doesn't have a portal, like it's not, it doesn't mean you're not going to invest with them. We've talked about how you're going to do your due diligence on the operators and the property and underwriting. We've mentioned those things in other shows, but the portal is not going to sway you one way or the other.
Portal won't sway me. Well, here's what I will say. Some of the older syndicators who are more old school, maybe been syndicating for a few generations or a few decades, I think they're less likely to necessarily have a portal. Now that we're talking about it, I'm thinking it through. Whereas a younger syndicator who is maybe comprised of younger staff is more likely to have the portal. I've never looked at this statistically, but I do think there's probably some type of correlation. And so, if anything, I like to invest with more experienced operators, like everything be apples to apples. So it's interesting to consider that. And now I'm thinking about it too, like I do have a number of logins, but I'm not in a tremendous number of operators who have portals, probably because a lot of them are older, more experienced operators. I wouldn't tell anybody out there to judge whether they should invest with someone or a syndicator based on whether they have a portal or not, honestly. If anything, if it's an older syndicator that actually does have a use of a portal, it may tell you, reading between the lines, that they are more forward thinking and tend to be more tech savvy, but that's about the beginning and end of it, I think. So it definitely would not sway me either way.
I couldn't agree more. And I appreciate how you elaborated on that. But, so when you see an offering and you see, I see it more common now that there's like tiers of investors, for specific deals. There'll be, class A, class B, one may be, more cash flow, one may be more equity, it'll be split up in different ways. I've seen a few different ways, but I just wondered your thoughts on that or which you like to see, or do you like those options like that?
Yeah, so it's really interesting to consider that now I see this all along through the cycle that the different classes of shares exist. And for those of you not familiar with what we're talking about, just to be clear, sometimes you'll find that there's class A shares for someone who's investing between $50,000 and X amount of dollars, and then maybe over $250,000, a different class of share, and the terms will be better, whether it's a preferred return or a split or both, for the investors that are obviously investing more money. And it's meant to incentivize someone to invest more money. So part of that's going to be, I think, dictated by the network of the operator and how realistic it is that they actually have larger individual investors. Part of it, though, has actually come up as a result of a recent phenomenon, which is there have been more and more investor groups popping up. And as those groups have been trying to negotiate better terms, you're going to find that there may be $1 million minimum, for example. Well, that's not necessarily meant for an individual investor, even though you probably wouldn't realize it reading the documents. That's actually meant for a group to incentivize them to get to a certain level that's maybe co-investing in the deal, as an example. And I'm generalizing, right? There's going to be exceptions. And so one thing that you may find as well is that, we're recording this in 2019. In my opinion, one person's opinion, I think we're at or near the end of a cycle. This is when there is the most amount of capital available, which means that there's the most amount of demand or supply of cash for syndicators to access. What that also means is that this gives them the best opportunity to get the best terms possible for themselves, right? If we have a downturn, and we do experience that, then what's going to happen is that there's going to be less cash available to invest. People are going to be more scared. Their net worths are going to be lower. Their stock portfolio is going to be lower, and they just won't have as much cash to invest. Then the terms are probably going to get a little better for investors because there's going to be a lack of supply of capital, right, that the syndicators are dealing with. The reason why I'm bringing all this up is because you may find that there's a higher propensity to have different classes of shares now to incentivize people to invest more because the syndicators can command it, right? In other words, the ball's in their court, right? So If they upset a $50,000 investor because they're giving a $250,000 investor better terms, they can probably afford to do that right now, theoretically. They can't afford to do that when there's less capital available. So you may find that you're going to find less and less of those come up over time, and then maybe, it's cyclical, so to speak. So I just want to point that out to you, because some people may not have thought about that. But, for me, I tend to be hyper diversified, as you mentioned at the beginning. And so I purposely put small pieces across a lot of things for my own diversification. And with that, it's extremely rare for me to hit the higher class of shares, because I'm normally investing between 50 and 100, say, sometimes a little more. And so I don't get the benefit from the higher class of shares, and it does bother me at times. It wouldn't stop me from going into a deal as long as I agree with the terms of the Class A shares. And I will say too that if I see Class A being 50,000 and then Class B being $1 million, all that tells me is that, yeah, there's some larger group who's negotiated terms. I'm kind of okay with that, because they do, at that point they are really bringing a lot of leverage to the table. So
yeah, I've seen some recently that were, like Class A were 100,000 minimum, Class B were 50,000 minimum. Where so Class A will receive straight, say, 10% return with cash flow distribution starting immediately. Class B at 50,000 minimum will operate with the traditional 7% preferred return, 70-30 split thereafter.
Yeah, that is a phenomenon of either an operator who's very experienced and can command the differences, or end of cycle. And I'm going to bet the deal you saw was actually end of cycle. The most common change I see is going from a 10 pref to an 8 pref. And was this a mobile home park deal?
It wasn't.
Oh, interesting. Okay, because you got to have a really rich cash flow to hit the 10% pref, so it's a little more unusual. But yeah, that to me is more likely a phenomenon of end of cycle, where an operator can command that. But also possibly, again, like I mentioned, the concept that it could be a more experienced operator who has access to a lot of capital. And I rarely see a 50,000 to 100,000. I got to tell you, normally the spread is 50 to 250, because there's not that much difference between 50 and 100. If I saw 50 and 100, that would actually bother me more as an individual investor, to be honest with you, because I feel like that person is forcing me to decide. Because to me, I don't invest in a 7 prep. I invest in an 8 prep or better. So that person may have just sold me out of their deal, actually, to be honest, no matter what the deal is. So, and that would bother me, because that's telling me that, like, for that little incremental difference, they're willing to just do away with me. And I don't know if I want to build a relationship with that person.
Interesting. Okay. So, moving on a little bit, I wanted to get your opinion about, investing in crowdfunding sites versus directly with a syndicator. Do you invest crowdfunding as well? Is that part of, diversification, or is that like something you don't want to do?
Sure. Yeah. So I am, I got to be careful in what I can discuss here, and that I'm an advisor for Realty Mogul. I've been an advisor for them since before they launched back in 2012. And so first thing to note for anyone listening is I'm not speaking on behalf of Realty Mogul when I'm saying this is just my opinion myself outside of my Realty Mogul advisory role. So look, for someone like me who invests full time, I tend to invest directly with operators. And that's because a lot of the crowdfunding sites are intermediaries, in that they take a portion of the profits and maybe a management fee in exchange for finding and vetting operators and then actually managing them going forward. So they provide a really good service for the right person. But for someone like me, I specifically do the work of networking to find the sponsors directly, to avoid investing with intermediaries for the most part. There are definitely exceptions. So I've actually never invested in a crowdfunding deal myself, okay? That being said, I think the crowdfunding sites are really a good fit for somebody who's either way too busy to do enough networking to find deals, who maybe is located in a non-primary city in the Midwest or wherever, where there isn't enough networking to facilitate them finding deals, potentially local deals, or someone who's just starting and trying to learn, and perhaps doesn't trust their ability to filter a deal, and they're maybe going to get help from the crowdfunding site to do an initial filter, and they're going to do the due diligence on top of that and reduce their risk a little bit. The bottom line is that typically investing with a crowdfunding site is a trade-off. It's a trade-off between having an intermediary in exchange for making it much easier to find a deal, and knowing that someone else is also vetting it and staying on top of it. So I think it's the right fit for some people and not the right fit for others. It's not necessarily the right fit for me. But I think that, now, one thing I will say though, is that not all crowdfunding sites are equal. Okay. I've actually been on the investment committee in the past for Realty Mogul. I've seen exactly how they vet deals, how many people look at them, how strict they are. I've been part of that decision-making process. I can tell you that I was extremely impressed with how thorough they were. I can't give you insight as to other crowdfunding sites. And I can also tell you that there were many opportunities that we looked at, immediately passed on. And I say we, meaning Realty Mogul. And then 3 weeks later, it was posted on another crowdfunding site, and we literally could not understand how it passed somebody else's test. So I would strongly advise anybody out there who's considering using the crowdfunding sites to do your best to determine how thorough the site is before you make a bet on their betting, or at least their initial betting. And you should always vet the opportunity yourself. This is your money, and you are making a bet on the crowdfunding site, but you've got to vet it independently. It's a trust but verify situation, I would call it.
And I don't want to spend a ton of time on this, but give us a couple ways that we can verify or vet the crowdfunding site.
Well, first thing is that you're going to want to understand the asset class well enough that you're looking at the deal from that crowdfunding site to have an opinion as to whether you agree with the rent inflation assumptions, expense inflation assumptions, the going in purchase price, the assumed selling purchase price, and the expense ratio, and many other things. And in fact, I was running through that, like I was just thinking like a typical deal. Every deal is going to have different things to look at. And so if you don't understand a deal well enough to know how to vet it directly from a sponsor, I don't recommend just jumping in and investing in a crowdfunding site, because you're going to want to make sure that you understand it well enough to know if the crowdfunding site, it aligns with what you agree with as far as assumptions. And the only way to do that is to learn enough first, to be educated enough to know if you agree with what they're proposing that you invest in.
All right. So moving on a little bit, but going back to really specifically dealing with more deal sponsors, Jeremy, do you expect, let's say you've had a relationship with an operator for a while. Do you expect the first right to be able to invest in an opportunity, or as opposed to it just being mass distributed, and then there being a waiting list?
Yeah, that is a great question. Look, this is clearly a subjective topic. I will tell you that I've seen this handled 3 different ways, actually, in my experience. One is that you're on a distribution list, no matter how many investors that operator has, and it's a first come, first served basis and blocking a spot, okay? Number 2 is that there are tiers of investors. So tier 1 is maybe who's invested with them the longest or the most number of times, or some method that they determine that you're in the A tier, right? You get it first, you get the first shot, and then the B tier gets it after, okay? The third way I've seen it is that a syndicator has so many investors that you can only look at every second or third deal. In other words, they have investor list A, B, C, and there's so many investors that each deal is going to fill out from each own list. And so they rotate, literally just random. You get today's deal, they get tomorrow's deal, the next person gets next week's deal, then it comes back to you a month later, right? I will say that, so I've been a part of all of those. And I'm kind of a principled guy, so the concept of fairness is what comes to mind to me. And to me, I think the most fair way to do it is just send it to everybody. There's actually issues with that too, because depending on which time zone you're in, you may be more likely to be looking at your email at 9 a.m. Pacific when someone else at noon Eastern is actually at lunch, right? So it's hard to solve this perfectly. I prefer to be in a situation where I'm getting every deal from the person. And I say that because I've been on the other side of the table. I've gotten every third deal from an operator I love, who I've invested with more than 10 times already. And I still cannot get. And so what I do to try to get around it is I try to be in touch with them as often as possible, ask them what's coming up, and just try to sneak into whatever else they're doing. But I have to work at that to actually get those deals. So for me, I strongly prefer to be on and one thing I actually really don't like is I was once a part of a very experienced senior living operator, and I was in their tier C. Okay. And I knew this because I'd asked them. And so they would go to tier A, then they go to tier B, and literally tier C would never get anything. And it was because they had been operating for 10, 15 years by the time I met them, and I was just in tier C. And it was really frustrating. They were still doing their deals, but it was just frustrating for me. What's also interesting from a syndicator perspective is that you never know when an investor is going to stop investing because they're run out of capital, they've decided to invest in other things. So from a diversification perspective, I think it's lowest risk for those operators to actually send it out to everybody at the same time for long-term, continued interest in their deals. But there's a lot of ways you can slice and dice this, that's for sure.
That's interesting. I mean, it's a few things there I haven't heard, and it's neat to hear. I mean, sending it out to your A list, your B list, your C list, and then, potentially the C list you're saying sometimes they won't get a deal. What if they go back to the A list and B list and stay there?
So when I was on that C tier, it wasn't that there were three lists. It's just that there was three. Tier A was like the VIPs.
I see.
And tier B was getting it. Okay, there was some left of the pie. So now that remaining piece of the pie is going to tier B, but I'm in tier C. There's never any pie left for me. There's just not even a crumb, and that was really frustrating. So what are you going to do?
Yeah. It sounds like you were doing it though, just by staying in touch and calling and letting them know you're very interested.
Yeah, I mean, I was doing my best, but again, I have an advantage because I do this full time. And so, I can actually track these things. I can be proactive if I want, but average investor is not going to really probably have the time to do all this.
All right. So, when someone's presenting a new deal, I'd like to know your thoughts about, like a webinar to present the deal versus a call, say from a syndicator, and what you like to see there.
Yeah. So again, this is very subjective. So just one person's opinion. I am really all about weeding through the deal and looking at the details in writing because from a convenience standpoint, I'm so busy. I like to be able to do it at 10 p.m., whatever time I want to do it. And you can argue that if you watch a webinar, you can do the same. But the challenge I have with the webinar is that I can weed through a document and within 5 minutes, pick up enough of the important points to know if this is something I should really spend a lot of time on. Well, with the webinar, I don't know how long it's going to take before I've gotten those key items out of it. It could be to the end. It could be a half an hour or an hour. So the webinar is not nearly as efficient from my perspective. What's the benefit of the webinar? Well, I think the main benefit of the webinar is that the syndicator gets to actually give their full message out without having to speak to 50 different people on 50 different calls. It's very efficient for them. Some people may like a webinar. Maybe they're driving home and they're listening to it on their car and it's a good use of their time. But for me, who I just try to be really, really efficient and I have the time to do this, I strongly prefer to be able to jump into the docs. And what I'll do is I'll start picking things out in the documents and the pro forma and create a very long list of questions from that. But if you're asking me to spend an hour listening to a webinar without knowing if a quarter of those questions are even going to be answered, just not a good use of my time. So I am probably being a little harsh because there's probably a lot of pros to the webinar that I'm not giving enough credence to. But I strongly prefer just getting the docs and being able to talk to the syndicator directly.
No, fair enough. And what about, phone calls from the investor or follow-ups? So say we've sent that email out, do you want a call from the operator or numerous calls? What does that look like?
Yeah, I actually would strongly prefer for them not to be like pursuing me. And again, I'm really biased. I am a very no sales pitch guy. If anybody out there researches me, you'll see I co-founded a nonprofit in 2007, which you mentioned, for investors, by investors. We started these investor meetings, public meetings, strictly for no sales pitch. That was the whole point, just to break even, no sales pitch, because of all the sales pitches I've sat through all the years of networking. So I don't like the concept of getting multiple emails. I'll take it, I'll review it, and then I usually will respond and be respectful and let them know I'm passing or not, just so they're aware. But I don't like it at all if someone's trying to hit me up 3, 4, or 5 times. It almost gives me the wrong message an investor that they're a little bit desperate. It may not be that that's the case, but I am personally really turned off by a lot of marketing like that.
Do you provide any feedback to people like that or to operators when you receive information?
Yes, almost always. I actually tell them why I'm passing. And it's not, the last thing I want to do is say like, here's why I'm passing, your deal isn't good. That's not all what it is, because there's 1,000 ways to invest and it just might not be the right fit for me, right? And it doesn't make it a bad deal or a wrong deal. But I like to give the feedback because what I don't want them to do is get the impression, for the ones that I really like and want to work with down the line, that I have no interest, right? Or that I'm just brushing off their deal. And so if I'm responding to a syndicator and telling them why I'm not investing, and most likely these days it's because I don't necessarily agree with market prices on average, right? And I want them to know that. I'll say like, I would say, look, I can't do this cash flow level. I'm hitting my minimum, or this cap rate's too low for me. The multiple's too high. But I really look forward to looking at stuff, once we have a market adjustment, and I'm going to take it seriously or something like that. Because I don't want them to think that I'm just not reading stuff and all that. If I'm trying to build a relationship with them in the future, part of my thought process is this whole tier A, tier B, tier C thing. I don't want to end up in tier C if I can avoid it, if it's someone I really like and I want to invest with long term. So you got to do a little bit of work on that. You're not the only investor looking at a deal.
You're thinking long term there. Maybe I should get in this deal so I can get into the next deal.
100%, yes. Long term for sure.
I like that. And so, I was thinking about just the process of how, as an operator, we have to take sensitive information or, bank account information and routing numbers and things like that. And so, what are your thoughts about how that's transferred, how we take that? Do you have questions of, is this secure? What are you doing with this as I'm telling it to you over the phone or, through the portal, or maybe they don't have a portal like you mentioned. How do you like to see that handled?
Yeah, great question. So I actually was indirectly involved in an incident recently where there was a hacker that hacked into somebody's email of the CEO and the CFO of, it was actually a startup I was investing in, which is very rare for me, but nonetheless. And if it wasn't for the fact that my friend who I brought in, who was investing as well, hadn't asked for the documents a little early, we all would have lost a combined $1 million to this person who had set up literally a company, a real company in another state with a very similar name, and they were intercepting the emails that were actually being sent from the syndicator, changing the wiring information in the email, but leaving all the rest of it the same. So it seemed like an email that was written by the person, because it actually was written by the person. And then, they created a very similar LLC name in another state. And it wasn't for my friend that asked me, does this state look right? And I'd already invested in the company in the past in a different state. And I was like, that's a weird state for them. It wasn't Delaware. It wasn't California. We actually figured out that it was being hacked. We were 24 hours away from all the investors getting this information. Just a very lucky situation. I was actually floored because, if you can believe this, the hacker actually called my friend because he'd been seeing the emails back from his signature to say, this is use the person's name. This is so-and-so, like, are you sending the wire? We're waiting for it. He actually was impersonating the person that was supposed to receive it, and actually called them 4 times one day to try to get the wire, clearly desperate to get the person's money for whatever reason. And it was really interesting. He literally called, the hacker had called my friend for this. So after seeing all this, I just realized how important it is, because I heard these stories, but once you're kind of watching it happen, it's a different situation. So I will be probably by phone calling myself, and not receiving a call, but calling people going forward. And unless it's just someone I already invested with before, and I've already used that exact information before with my wiring and everything. So yeah, I think it's becoming a much more important topic, and I unfortunately think this is going to become a more common occurrence going forward.
That's a great idea right there. I'm glad you said that. So, having the investor call you so they know who they're calling. Yeah.
Yes. Now, I know that some people like using their portals, and that theoretically, like, an investor should be able to log into a portal and look at information that may have been, like, in a document that may have been uploaded there. And some people are using that as a safety guard, and I think that's not bad. But you can argue that technically that can be hacked, and that someone else can be, it just like the email was hacked. So if you want to be 100% sure as an investor, it's a lot of money at stake, then I would strongly recommend calling. Also, and I don't want to get this wrong, but I believe a wire is like giving a cashier's check. It's cash. So once you send it, I believe you cannot get it back. Hopefully I'm not giving wrong information out. And ACH, usually you can catch it and reverse it, or sometimes, depending on the bank, within 1, 2, 3 days sometimes. So wire is like cash, and ACH is more in process and can sometimes be reversed. So if you have the ability to choose, I would choose to send an ACH instead of a wire if you have that choice. You should definitely check with your bank on whether that's correct information I just gave to you. I don't want to get it wrong, but there is a difference actually in being able to reverse the transactions between the two.
Yeah, no, that's great advice. And unfortunately, we're about out of time. But I know you had mentioned, I think, in a different show about different strategies for raising capital for like the passive investor raising capital. And I think, or you wanted to elaborate on that.
Sorry, I don't quite understand the question. I apologize.
Now, you and I were talking about different strategies for raising capital for the passive investor, and I'm not sure if you were thinking of different ways they can come up with capital to invest, or I'm not sure either. It was from notes.
Drawing a blank on that. I'm sorry. I know it was from before, but I'm sorry about that, but I'm drawing a blank on that.
No problem. No problem. Sorry. Well, Jeremy, why don't you tell us again how you like to give back, and then tell the listeners how they can get in touch with you.
Absolutely. So again, thanks for having me on. Really appreciate it. So honestly, I've been very fortunate. 17 years in, I live off the passive cash flow now for the past 12 years full time, and I am happy to help anybody out there. If you're either starting or you're an experienced investor, you have questions, or you want to network, or you're a sponsor, you're looking for investors, whatever. I'm all about. I have the time, so I'm happy to make a call. I don't charge for a call if somebody has questions or whatever. So please feel free to reach out to me. Best way is through email, which is jroll, JROLL, @Roll Investments, which is ROLL Investments with an S.com. So jroll @rollinvestments.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.